Good afternoon, everybody. If you're in Eastern time zone, my name is Brady Plunkett. I'm a portfolio manager at PWL Capital, and I'm joined by Jaclyn, who's going to lead this session with me, focused on the first home savings account. It's a brand new opportunity here, new planning opportunity for Canadians. Something that we're all, well, I don't know about all. Definitely me. Like, I'm pretty super excited about it. We haven't had a new registered account come to Canada in a long time. When we dig into this is still super new. It's only available to banks starting April 1st. And as we wrap our heads around it, it's really super exciting in terms of the planning opportunities that are available for a widespread, amount of the population, that we thought we would kick off this session in terms of an information session and a chance to engage with you guys. Just one quick note before we get in here. It's very easy for Jaclyn and I to really get off on a tangent and really start talking about it. And there's lots that we could talk about. There's lots of different areas that we can cover. I don't think that would be the most valuable use of our time together today. Even if you look at some research, it shows that people check out the longer certain amount of people talk for prolonged periods of time. How this would work best is to get as many of you engaged in the conversation as possible. There is a function inside the Zoom where you can actually choose to put your hand up if you have a question. There's a software that's going to allow everybody to engage to various levels. And I would really, really appreciate as many people tuning in and putting their hand up and asking as many questions as they can to ensure that this time is best spent, just not, listening to us about an account. JC, anything you want to add, or are we good to proceed here?
No, that's great. I think, so we're both financial planners by trade, and there's a lot of questions about this new account. It's brand new to Canadians, and no questions are dumb questions. So we just want to help you make sense of this. So please don't be shy with your questions. If you're thinking it, I'm sure at least two others are thinking the same thing. With that, we'll kick it off.
Okay. Oh, actually, there's one in the chat right now. Hold on. Let me see. Why aren't institutions ready to take deposits on this program? Let's actually just start with that. So they're in financial services. There is a pretty significant, back office operation for every single institution that needs to wrap their heads around what this means, how to get people to qualify, how to verify the identity of those that are applying for the account. That can take a while. So essentially, especially with asset managers, we're seeing a little bit of a prolonged delay in rolling it out. But please keep an eye out, everybody's going to, share their announcement when it's ready, but most as of today are not ready to actually open one. I know Questrade has one available that you can open, and I think National Bank on the banking side, but I think that's kind of it for now. Okay, here we go. So just to kind of follow along here today, what we're going to do is there's going to be some questions that we could get to throughout this conversation. Whatever laptop or phone device that you're on, if you can go to www.menti.com and enter the code that you see on the screen right now, that will enable you to participate in the session today, or you can use the QR code. This is just a high level overview of the entire account. We're not going to go through this, but I think it would be really helpful to go back to this as a comparison for questions that do come up. So as everybody's getting logged on to Mentimeter, the first question that you're going to see here is, are you planning on purchasing a home within the next 5 to 10 years? How many do we have? We have 29. Okay. So we'll let responses roll in here for a bit.
We've got a question in the chat. So my daughter is 18 and we live in BC. I was advised that she has to be 19, and I heard in Ontario you can be 18. Is the age based on the age of majority in each province, or is it national age? That's a great question. It is based on the age of majority in the province of residence.
I think 19 Now, is that the age of a minority to open a non-registered account? So these are registered accounts that have different rules, but there are some provinces where you're not considered an adult until 19. And I think BC is one of them, which may be where that question's coming from. Okay. So we've got 9 yeses and 4 nos for those planning to purchase a home within the next 5 to 10 years. Let's actually go to the next one, which is, are you planning to rent long-term for your living accommodations? Just flipping this around a little bit. Okay, we've got a number of results pouring in. 13 and 3. I really hope you guys aren't annoyed with what I'm about to do. Okay, there's 81% no. So no matter what you actually answered on either of the last 2 questions, the first home savers account is something that could actually that could actually be totally relevant for you, no matter if you're a renter long-term or if you're actually looking to purchase a home. To that note, I think it's important to just kind of dust off what the qualifications are to actually just open the account. So number 1 is, like Jaclyn just mentioned, you have to be at least 18 years of age, and you cannot be older than 71. So there's a wide age group that this applies to. You cannot have lived in a home that you have owned or your spouse has owned in the last year or either of the last 4 calendar years in order to just open the account, which is pretty interesting because even if you have purchased a home in the past and for whatever reason your life has changed, you have decided to downsize, you've decided to move in with a roommate, something might have happened. If all of that happened in advance of the previous 4 calendar years, you are actually still considered a first-time home buyer for the purpose of opening this account, which is pretty cool. And even if you never have the intention of purchasing a home someday in the future, and you are just banking on being a long-term renter, which a lot of Canadians are, you can actually still open this account, even if you do not have the intentions to withdraw it for purchasing a home. That can be something that's really appealing if you're earning a good amount of income, because contributions into this plan are tax deductible, which we'll get into in a moment. And this could actually be a side tax planning opportunity, even if you're not in the housing market, which is pretty sweet. There is one more criteria that I hadn't mentioned that you need to qualify for in order to open the account, which is this next, well, actually it's coming up. This is something that I put in. What's up? What are some specific questions about the FHSA that are on your mind? So obviously there's a chat function in here, but what we'll do is I think there's an open-ended responses that you guys can submit other questions on here if that's something that you guys are ready for.
So I think maybe to start, would it be good to go over the characteristics of the FHSA and how it differs from an RRSP, how it differs from a TFSA? We have an answer in there. We have a chart that's just a very simple who's who of the 3 accounts. So we can go over that.
Yeah, I'll go back to that, JC. There we go.
Okay. Perfect. So I think for anyone who doesn't have the background yet, again, we don't want to be doing all the talking today, so we'll make it very, very short. I see some questions rolling in, but please don't be shy with any further questions. The FHSA is really a hybrid of the 3 accounts you're seeing there, the RSP, the TFSA, and the RESP. The wonderful characteristic about the FHSA that makes it similar to an RSP is that you get the tax deduction for dollars you put into the account. So for every dollar you put in, you get back from the CRA an equivalent amount of your whatever your marginal tax rate is at that time. So that's very handy. TFSA characteristic that it shares is that whenever money is taken out ultimately from the FHSA towards a home, it is not taxable, which is wonderful. And the characteristic that it shares with the RRSP is that your room carries forward from year to year. So if you open an FHSA in 2023, but you don't have money to contribute until 2024, that's fine, because you can contribute your 2023 room of $8,000 plus 2024 room of $8,000 next year.
Yeah. Maybe the other cool thing to talk about, Jaclyn, is you just talked about RRSP catching up with carry forward contributions. You can do that in an RRSP across the lifetime of how contribution room has been credited to you. With the FHSA, let's say you have accumulated the entire contribution room amount for an account holder, the maximum, which in this case is $40,000, as you can see on the chart. Let's say you don't make a contribution to the FHSA for 5 years, but you're accruing the room throughout. You can, in the first year, make a $16,000 contribution to catch up 1 year behind you for the FHSA. In the second year, this is what we just learned yesterday, and this actually went through somebody that was sitting at the legislation table when this was kicking off. In that second year, or year 6, if you want to call it that in this example, you can actually only contribute $8,000 because you can only look 1 year backwards in catching up with a year that you might have missed, not across the lifetime of the actual account, which is what the RRSP entails. So that's, I guess, a major discrepancy in terms of carry forward contribution limits with the FHSA. If we go back to that original point here, oh, here we go. There's some questions on here. I own a property, but rent it out and live at home. Can I still qualify? GC, do you want to do that or should I?
Go ahead.
Yeah, cool. If you own a property, but you rent it out and live at home, I guess the question I have for whoever asked that is, the home that you live in, do you own that as well, or do you rent those accommodations? And if you put your hand up, we'd be more than happy to have you join the conversation live. This is Ruben. Okay, I don't own the home I live in. Okay, oh, sorry. I gotta scroll up here. So Ruben, if you don't own the home you live in, but you have a rental property, yeah, you are actually considered a first home, a first home buyer under that definition, and you do qualify to open an account and use this if you are residing in a place that you are renting. This is awesome. Jindy has a question for us. I was the executor of an estate within the last 5 years, and the properties were put into my name as the executor. However, I did not live in the residence. Can I still use the FHSA? Occupancy is very important when it comes to this definition. So as long as you are not living in a home that you own or that your spouse owns, then yeah, you would still qualify under the definitions of this account.
That's a really good question here. We are interested in opening an FHSA account for our adult children, looking for info and strategies for maximizing benefits. So this is a less obvious strategy, but incredibly valuable if you are looking to help your adult children buy their first home. So you can't open the account in your name if you own your home. Obviously, you're not a first-time home buyer, but your children can. So let's say your son and daughter each open their own FHSA. You can gift them $8,000 this year to contribute to the FHSA. And there's no tax on gifts between adults, like to your children at that age. So you can just gift them $8,000. They put it in their FHSA. They get the tax deduction, and they can use those funds towards their home purchase. There are other strategies you can look at too. Like if you're not looking to actually gift the $8,000 per year, you want to look at it more as a loan. You can gift the $8,000, the child gets the tax deduction, when they ultimately go to make the down payment on their home, they can withdraw the funds and you can look to be paid back at that point too. There's a lot of things that you can do, but really what you're doing is you're gifting them the tax deduction after all.
Oh, there's a bunch in here too, eh? I guess maybe the other thing, just on that point, I think you summarized it really well, Jaclyn, like you're gifting them the tax deduction. Typically, for those that were looking to save for a home, it was, a bit of a conversation between the RRSP or TFSA. The RRSP, of course, assuming you were participating in the home buyers program. This FHSA is super cool because the tax deduction can actually carry forward indefinitely, that you can apply. So even if you are not earning a reasonable amount of income to use the deduction in a single year, it is still an attractive option because you can carry it forward indefinitely and then still qualify, assuming you're purchasing a home and nothing goes sideways, for withdrawal towards purchasing a home in the future. This is an interesting one. Can money be deposited into an FHSA directly from my pay before taxes, similar to the RSP? So we're getting into edge cases a little bit. My understanding right now is I actually am not sure whether or not that can be facilitated amongst employers and the FHSA. I would assume that would take a little bit of time to roll out. But I am unsure of any employers that are offering that service right now, but that would be an interesting question.
Mm-hmm. Perhaps for smaller businesses where there's more flexibility, I can definitely see that being an option.
Cool. There's a bunch of others on here too.
When possible, to contribute to both the FHSA and the TFSA, so we've got room available in both, which account is more beneficial to contribute to? That's a great question. And it's going to be specific to your situation, but the way I see it is the FHSA is incredibly valuable because of that, the ability to get the tax deduction. If you don't end up buying a home, you can just transfer the funds in your FHSA to your RSP. So really what you want to make sure of is if you have funds elsewhere to draw on, like if you have an emergency fund that is outside the TFSA, outside the FHSA, and you don't need liquidity, I would say probably go with the FHSA because you get the tax deduction and you still have the flexibility with that account.
Cool. This one that I see right here. If I rent out a property I purchased and never lived in it, after qualifying and opening an FHSA account, then would I be allowed to move into the property and still accumulate in the FHSA? That's super interesting. So you've rented it out in this scenario. You're absolutely qualified to open it. Would I be allowed to move into the property and still accumulate in the FHSA? So this is, in this example right here, I'm talking about this question. This is going to be unrelated to proceeding with a withdrawal. Because in this scenario, if you have already financially owned it, but you're not living in it, that would be interesting. So you would be considered a first-time home buyer to open the account. Let's say you wanted to use the money to withdraw and apply against the property. Like let's say there's a mortgage outstanding or something like that. There's some debt outstanding. Under the, as I understand the current rules, and again, we're still getting used to this stuff. I would actually think that you would be allowed to withdraw that money and apply it against any mortgage or debt outstanding connected to that property that you're thinking about living, that you're thinking about moving into. Which does bring me to another interesting point in terms of closing the account down. Because what we've been talking about is opening it, contributing so far, and then withdrawing for a qualifying purchase without paying any tax, which is super sweet. The moment that you decide to proceed with a qualifying withdrawal to purchase a home, there is a clock that starts for which you would need to close the account down by a certain date. And that is not applicable to any other registered accounts that exist today, except for the RRSP, where there's a clock where, depending on the beneficiary's age and stuff like that, it needs to be shut down. But let's say you make a qualifying withdrawal to purchase a home this month, April of 2023, just for an example. That FHSA needs to be shut down and closed by December 31st of 2024 in that example. So it's 1 calendar year after you have proceeded with a withdrawal where you need to work with your financial institution to close the account. So that clock is something to also keep in mind when you're thinking about withdrawing.
So if I'm buying a house by the end of this year or starting of next year, should I open the FHSA or should I wait until I buy it and turn it into a rental? I want to maximize my FHSA and RRSP benefit. So you're buying it by the end of this year, but you're going to turn it into a rental. So you're not going to occupy the home. In order to use the FHSA, you would need to intend to occupy the home within 1 year of acquiring it. So I'm not sure how to answer your question.
The other one, I didn't want to skip over this, JC, sorry. There's one that says, if the home I live in is owned by my holding company that I hold 100% shares of, am I still eligible for the FHSA? So as the rules are written right now, it says to open an FHSA, you must be a qualifying individual. So there's not enough description that I can find right now where if you're an individual that owns 100% shares of an entity, does that pass through, and would they look through to that as well? Or would they stick by an individual as an individual person? I'm not 100% sure if you would be eligible for the FHSA, but as it's written right now, it does specify individual.
Another great question. Are there restrictions on what can be held in the FHSA? And is there a recommendation of what to hold, if I can answer that? Awesome question. So an FHSA, gosh, what a mouthful, can hold the same investments as an RRSP, TFSA, anything you can think of, stocks, bonds, mutual funds, high interest savings, GICs. For this type of account, if the goal is short-term savings, let's say you're going to buy a house at the end of 2024, you probably don't want to be invested in something like all stocks, because that comes with a lot of volatility, a lot of up and down in the price movements of the securities you're holding. So typically what you'll see is something like a high interest savings account, which right now high interest savings are paying somewhere around 4 to 5%. So not a bad deal if you're saving for your house. Just probably park it in high interest savings, unless you're looking further out to like the 15-year mark. And then there's other things you can do there.
Cool. I'll take this next one. What are the tax implications of transferring investments in kind from a TFSA to the FHSA? Is this something you would recommend if an FHSA is more beneficial to specific circumstances? Cool. So number one, a direct transfer in kind from a tax-free savings account, a TFSA, is not allowed, is not permitted as of today into an FHSA. An indirect transfer is absolutely permitted, where you would actually withdraw or deregister the amount of money that you're looking to get into the FHSA, and then subsequently recontribute it back into the TFSA. What I just described is actually allowable in any direction from the RSP to the FHSA, which we'll get into a little bit later. For the TFSA right now, that's not recommended. If I were to speculate, the question behind the question here is, I mean, where is a better place to hold money, TFSA or FHSA? So number one, you would have to consider the specific circumstances like what's mentioned here, and understand what the objective of the money is, what you're looking to accomplish by what time, and what your overall goals are as a starting point. Moving money indirectly into an FHSA can be super interesting because there is a tax deduction component of that account that the TFSA right now presently does not provide. So subject to certain contribution limits of $8,000 a year, $40,000 in total in the account, the account holder would be subject to a tax deduction in the FHSA and not the TFSA. So that would be the big piece to consider. Knowing that if you are on track to actually withdraw it and purchase a home, there's the same amount of flexibility as the TFSA to get it out of there anyway on a tax-free basis. That was a nice little stretch. Is there any questions in the chat here that we can?
I think they've mostly been answered. I just wanted to clarify the tax deduction piece too. I often get a lot of questions about this. So if you are maximizing an $8,000 contribution to the FHSA or likewise to an RRSP, when we say you're getting a tax deduction on those funds at your tax rate, means that let's say you're at a 40% marginal tax rate, you get about $3,000 back in tax if you put in $8,000 to your account. So it's a really good way to increase your down payment savings by doing it in a tax efficient way. The alternative, I guess, would be putting $8,000 in your TFSA, getting no tax deduction, so not getting the $3,000 back. So that can be impactful.
The other thing, just while we're talking about contributing to accounts, is when we think about the RSP and TFSA, actually accruing the room is important for an RSP. It's by function of earning income in Canada, subject to what that definition is. And in TFSA, if for the TFSA, earning contribution room is being a Canadian resident and being an adult in Canada to actually earn the contribution room. The FHSA, if I were to go to this next slide, actually, we'll get into it right there. Which status matters to qualify for the FHSA in terms of actually opening an account and then contributing to it? I might have just given it away. And if you're listening, you probably picked up on it. Yeah. Residency. Yeah, I spoiled it a little bit. So you actually have to be a resident in Canada to actually open it and then contribute to it. Along with being at least 18, no older than 71, and being considered a first home buyer under the definition, where you haven't owned one for the last 4 years. You haven't lived in a home, or your spouse hasn't lived in a home that you own for the last 4 years. Now, there is a contribution clock, which I think is important to discuss in light of actually acquiring the room. Because even if you meet those criteria and you don't have an account open, you are unable to start acquiring participation room, is what they call it, in under the FHSA, until you have an account that is opened. That account needs to be open to qualify for the room, and that's unlike any other account. Now, the thing to keep in mind as you open an FHSA is it also, by definition, starts a 15-year clock by which you need to make a decision of how the funds inside that FHSA are allocated, because there's a 15-year maximum period, participation period, that can exist under the account. After 15 years, you have the option to withdraw that money as a qualifying withdrawal to purchase a home if that's something that you're ready for. You can take it out and pay tax on it if you want to deregister or close the account. Or, and this is where it becomes interesting for renters who are not in the market to actually purchase a home, you can transfer whatever is in the FHSA over in kind into an RRSP or a RIF as another option by the time that 15-year participation period ends. And that last part provides a lot of flexibility for why this is such an amazing tool. But there is that clock starts the moment that you open an FHSA at any financial institution, and that's something important to keep in mind.
So we have another question here in the chat,
Yep.
Brady. Do we need to pay any tax when we withdraw from the FHSA account? So there are two types of withdrawals from the FHSA, a qualifying or I guess non-qualified withdrawal. qualifying as it's going towards your first home. Another type of withdrawal that is not going to be taxed is if you over contribute to the FHSA and then you withdraw the excess amount, you will not be taxed on that. So if your room is 8,000, you accidentally put in 10,000, there's going to be tax on the $2,000 excess until you withdraw it and effectively fix it. Once the 2,000 is withdrawn, you're not going to be taxed on the $2,000. If you simply withdraw from your FHSA outside the scope of those two reasons, it will be included in your income for that year, so you do pay tax on it. So ideally, you don't end up in that boat. If you decide you're not going to buy a home, so you're not going to make a qualifying withdrawal, and you've not over contributed, then you would ideally just transfer the funds to your RRSP after the 15-year period. You would not withdraw them.
Sweet. I think we talked about this enough where everybody's getting this right, which is really awesome. In case you haven't voted yet, you can go vote 8,000 because that's the maximum amount of participation room available. The other concept that I think is worth touching on is, especially in the RSP world, there's this concept of a spousal RSP that facilitates a mechanism of future income splitting with your spouse or your common law partner, which is super interesting. Even though the FHSA could serve as a long-term retirement planning tool, a spousal FHSA does not exist yet. They're only available on an individual account holder basis. What is super interesting, and this is like the TFSA, is that so far as we understand it, CRA does not have any prohibitive measures of actually stopping you from gifting money to your spouse for the purpose of contributing into their FHSA and then claiming the deduction and using it as a future planning tool as they see fit. They call that attribution under Canadian tax legislation, and that does not appear so far to be something that's going to get in the way of using this tool. Even though there's no spousal FHSA, you can gift it to your spouse without penalty so far. Okay, let's move along here. So this is a bit of a, I don't want to call it a little mini trivia, whatever, but there's 3 statements on here. And if you could select what you guys believe to be the correct statement for each of these three statements, that would be cool to reflect on. Okay, 2 people have answered, 4 people have answered, 5 people have answered. This is where the group might get a little bit annoyed with me. I admit this is a bit of a trick question. I'm really sorry. If I was participating in this, I'd roll my eyes. So there's 10 people that have participated. 3 have gotten all 3 of them right. Number 1, everybody got right. Number 2, everybody got right. Number 3, you do create FHSA participation room as an adult Canadian resident, but the account needs to be open. You need to have that account open in order to start that from going on. So I guess technically it's correct, but there is more to that definition that you would need to pick up on in order to get that right. I'm really sorry. I know that if roles were reversed, I'd be rolling my eyes right now, but that is true. You have to open the account to get the room. So here's an interesting nugget. For those that are contributing on an ongoing basis or lump sum basis to your RSP, do you think about contributing to that RSP on a calendar year basis, meaning from January to December, or on a tax year basis, meaning after the first 60 days of the calendar year has elapsed until, let's just call it, the end of February? And there's no right answer here. This is just an interesting kind of nugget. Calendar year, tax year. For 3, okay. A lot in calendar year. So the segue here to the FHSA is that Unlike the RSP, the first 60 days of the next calendar year, you are ineligible to make FHSA contributions if you want those contributions to be applied against your income tax return for the previous year. So February 1st, 2024, you've got some extra money and you're looking to contribute it into your FHSA and use it as a deduction for your 2023 tax year. That would not be allowed, but you could still put it into your RRSP and then claim the deduction as well. But the first 60 days is not an additional window of opportunity when it comes to the FHSA. It's got to be on a calendar year basis and something that's on your checklist right after Christmas. Okay, I inserted this as a bit of a breaker point. I know we've covered a lot. This is another open-ended question opportunity for you guys to ask stuff that we haven't talked about, or maybe we have and you'd like more detail on. We're happy to take this in whatever direction you guys want.
No questions.
Or maybe people are typing, I'm not sure.
So Brady, you were talking about spouses earlier, and I did just want to mention a little distinction that it has with the RSP. So you can designate a beneficiary on an RSP, a TFSA, and the FHSA. So there's no difference there. The difference is how the funds are treated on death. So with an RSP, for example, if you designate a beneficiary and you die tomorrow, the money goes, the full market value of your RSP goes to the beneficiary, and you or your estate pays the tax on that RSP as if it was all withdrawn on the day of your death. So for the FHSA, it's a little bit different. You can designate the beneficiary after you die, it goes to your beneficiary, but the distinction is the beneficiary then has to pay the tax on the market value of the account. So something to keep in mind when you're looking at estate planning.
Especially if the beneficiary is in a pretty, high tax bracket as it is. Like that could erode a big amount of the account if something ever happens to the account holder. Okay, a couple good questions on the screen here. I'm actually going to jump into number 2, Jaclyn, if that's okay. This is can you transfer an amount from the RSP to the FHSA without any tax implications? So the short answer is yes, but there's a little bit more to that. As we know, there is contribution room for the RSP and what we're referring to as participation room for the FHSA. If you decide to transfer an amount from your RSP into your FHSA, the value of that transfer cannot exceed any available participation room you might have in the FHSA in a given year. So in most cases, that's going to be $8,000. Or if you're looking back one year where you didn't contribute, that could be $16,000. But the value of that transfer cannot exceed the available participation room that you have. The second important bullet is transferring an amount from the RSP into the FHSA. Let's say it's within the participation room that you have, will not result in a tax deduction for the account holder. I'll repeat, even if you have the participation room and that money's coming from your RSP, it will not produce a tax deduction for the FHSA account holder. That's going to be something to keep in mind. So it can occur without any tax implications, but it's less favorable than from a tax deduction standpoint than contributing the money from your own cash reserves. I think that's an important thing to highlight here.
Would it ever make sense to transfer funds from the RSP or TFSA to the FHSA? So that's a little part 2 of the question Brady just answered. So the RSP The plan that you can use to help to go towards your first down payment is the home buyer's plan. As you know, the home buyer's plan has a 15-year repayment requirement. So if you take out up to a maximum of $35,000 from your RSP, you have to start repaying it 1/15 at a time, 2 years after you buy. So if you're trying to get away from that repayment schedule, maybe you just want to withdraw from your accounts and you don't want to have that obligation to repay, you can transfer up to the amount allowable from your RSP to your FHSA and maximize the amount you're withdrawing from the FHSA, minimize the amount you're needing from the RRSP. So that's one reason you'd want to do it. Something important to consider though, if you do go from RSP to FHSA, you wouldn't get that room back, that RSP contribution room. So for example, you take $8,000 from your RSP, it goes into your FHSA, you continue building your FHSA, you ultimately make a down payment from your FHSA, and now you own a home. So funds have gone from the RSP, FHSA, now into your home. You've kind of lost that RSP contribution room and you aren't able to repay it. Whereas under the home buyer's plan, you're forced to repay it. So you get that tax deferred savings room back. It's not all lost, but it's just something to consider.
JC, I'll take this next one about the home buyer's plan. I'm going to need you or anybody actually that's participating here to like put their hand up and stop, because I could nerd out a bit here. I'm really sorry in advance, but there's lots of cool distinctions between FHSA and home buyer's plan. So question is, if you are thinking of buying a home in the next year and you have the opportunity to contribute to the home buyer's plan, can you contribute to the plan to lower your income and withdraw in the same year for the home? So for the home buyer's plan, there is a holding period of 90 days where the money needs to be in the RSP before you withdraw it for a qualifying purchase. That's a separate program from the FHSA, but it is totally relevant for most plans or for most Canadians' plans. The next thing that's important to mention is the home buyer's plan can coexist with the FHSA opportunity for the potential withdrawals for the same qualifying purchase or the same home. Yes, you can use both to save for a home. Now, the FHSA, the First Home Savers Account, is an account. It's not a program. The home buyer's account is a program within the RRSP account. And that program, as of today, specifies a withdrawal limit of $35,000 that you can subtract or transfer out from your RSP without tax implications in the short term and put towards a purchase. The FHSA doesn't have a withdrawal threshold or a maximum withdrawal threshold. So depending on the investment or the experience of the investments that you decide to hold in your FHSA, let's say, and this is not advice, we are not here to give financial advice. Let's say your investments do phenomenally. It is not worth $40,000. It's worth $80,000 at the end of that 15-year clock in this example. You can take the full $80,000 out and apply it towards a qualifying home purchase, in addition to the specified 35 that's coming out of the home buyer's plan. Now, what comes out of the home buyer's plan does, as Jaclyn, I think, mentioned, have a 15-year repayment period. Otherwise, whatever doesn't get repaid is shown as taxable income on the account holder's T1 in the given year. The FHSA does not have a repayment obligation for whatever gets withdrawn from the account. That's another difference from the home buyer's plan. So for those that are not attracted to the idea of putting money back into the account, that is not a worry when it comes to the FHSA. You don't have to repay it. I'm going to touch on one more thing. I'm really sorry because I think this is important and it's exciting for me. Is this question asks, can you contribute and then withdraw it in the same year? And we talked about a 90-day holding period where the money needs to be there. Okay. Let's say you have come across the home of your wildest dreams and you are going to need the money soon and you're considered a first-time home buyer, et cetera, and you can open an FHSA. The really interesting thing is that you do not have a required or a minimum holding period in the FHSA for how long the money actually needs to be there. In theory, you can have it in there for a day after the account is opened, and then proceed with a qualified withdrawal right afterwards to actually buy the home if it's something that's on your radar. There is no required holding period for the FHSA. That's another distinction from the home buyers plan. Both can work together. Both are different, but the introduction of the FHSA makes all these planning opportunities a lot more exciting to make it worthwhile for Canadians.
We've got questions all over the place. So another one in the Q&A. So how are U.S. assets treated from a tax treaty perspective? Another good question. So U.S. stocks held in the FHSA, we are guessing they're going to be treated the same as U.S. stocks held in a TFSA. So the RRSP is distinct because it's part of the U.S.-Canada tax treaty, and U.S. dividends get special tax treatment within an RRSP. In the TFSA and likewise in the FHSA, you're probably not going to see that special tax treatment because it banks on the IRS recognizing the FHSA as a tax exempt account, which it does not for the TFSA. So the TLDR is that US stocks will have a 15% withholding tax rate on dividends paid out, and you're likely not going to see that up front. So you're going to get the net dividend. If you get paid $100 dividend, you're going to see $85 deposited as a dividend to your FHSA. And the downside of that is that you can't claim foreign tax credit for that. So you can't claim the lost tax because it's in the FHSA. So not ideal.
Cool. Well, I guess there would have been more questions that would have been submitted here, but we can keep rolling, I guess. Cool. What is TLDR? Sorry. I didn't understand.
Didn't read. You got to get on Reddit, Brady.
Or too long didn't. Okay. Too long didn't read. Okay. This might be another trick question. This is for the audience. Withdrawing from an RSP TFSA is unrelated to closing the actual account. I think the underlying message we actually went over here today, but let's see what the responses are. True, true, true. Awesome. Maybe we made these too easy. Absolutely true. The only thing that's different about the FHSA is, as we mentioned earlier, the moment you proceed with a qualifying withdrawal to purchase a home, a clock starts where you actually have to close the account. And it is the end of the following calendar year from when that withdrawal takes place. And that is unlike any of the other registered accounts that exist today. I think we've talked a little bit about transfers, but here's another one for you guys to vote on and participate in.
We've got a core people, a core group of people who are engaged throughout the whole hour. Same amount of people answering each question, which is great.
So both directions is absolutely correct. I think what we talked about last was RSP into FHSA. I think maybe just quickly to touch upon FHSA money into your RSP account. Your RSP contribution room is derived by earning income as it's defined in Canada. Now that transfer, any transfers from an FHSA into an RRSP, my understanding is will not impact any RSP contribution room that you have available. It is separate from what that calculation looks like on your annual notice of assessment, which is not the case going the other way. As mentioned, money going from your RSP into your FHSA does require the FHSA participation room to exist in order to facilitate such a transfer. It doesn't lead to a tax deduction, but if you go the other way, that will not have any bearing on the RSP contribution room that anybody might have, which is super, super sweet. Just as a side note here, if you're looking for your own RSP contribution room, an easy place to go look is your notice of assessment. That is an appendix attached to your taxes and is on, I think it's on a schedule if you look at the your full tax return. The FHSA participation room is going to be added to a section of your NOA. So in the future, you can go and look for the available maximum participation room that you have on your notice of assessment, similar to where you go looking for your RSP room. Okay. Oh, we did cover this, eh? I think we did cover this. Actually, let's see how many people were listening. Yeah. Yeah, there's less of a cliffhanger for this one.
Mm-hmm.
You guys are absolutely right. It is 90 days that it needs to be held in the account before you can take it out for a qualifying withdrawal on the home buyer's plan. And then the segue here to the first home savers account is that is not necessary. There's no holding period requirement right now. It'll be really interesting to see if that changes. It'll be really interesting to see how the rules develop and evolve as the usage of the account takes place and how CRA might choose to amend any of these rules. But for right now, it doesn't need to be there for any time under the FHSA, just a day.
And that's the thing too. So there's been talk of the FHSA for a long time. At the onset for a while, the conclusion was you could not use both the home buyer's plan and the FHSA to fund your first purchase. That has obviously since changed. And I think to your point, Brady, it will continue to change as we get used to having this new account.
Awesome.
Okay, so it looks like I think we're done for today. Thanks everyone for your time. We appreciate any feedback that you have. We're just getting going with these webinar type of events. Oh, sorry, we do have one question from Vamil. Do all financial institutions offer the FHSA? Not yet. So a few of them do for now. Questrade, TD, I think National Bank on the direct investing side. Someone in the chat said RBC is also offering it now. It's going to be a slow rollout over the next year. I think most institutions should offer it for sure by the end of by the end of 2023. So thanks everyone for your time. If you want to reach out to us, we're happy to connect on LinkedIn. Yeah, any feedback is welcome.
And we're gonna keep rolling these out at PWL. Right now, at a minimum, we're aiming for like once or twice a month. And we're going to promote this as widely as we can. And the topics are going to change. They're going to vary. This one's kind of white hot right now, given the fact that it's, the launch month or supposedly launch month has been April. But please keep an eye out for further information about other sessions that PWL advisors are going to be leading. From Jackie, I missed the answer. If my FHSA grows to, I think it was $100,000. Yeah. Do I pay tax on withdrawal? Jackie, if it's a qualifying withdrawal and your FHSA grows to $100,000 and you qualify, you can take it all out without any tax implications. And no repayment obligations either, unlike the home buyer's plan.